Welcome to Taking Stock. I'm Amanda Lang. Coming up in the show, a look at our debt, including who has it and whether they can afford it, some advice on managing some of the big debt decisions, and how our own behavior can get in our way or be used to help. That's all ahead. First, a look at the sheer cost of debt. We know Canadians have a lot of it and that inflation has made our debt even worse. Here's a look by the numbers. First, household debt, which actually fell during pandemic, is up again at $1.83 of debt for every dollar of disposable income as of third quarter last year. Higher interest rates add up. Interest payments on debt rose a record amount in those same 3 months, 16.2%, and will only have grown since then as rates rose further. That jump meant interest payments as a share of total debt payments rose to 51.3% in the third quarter from 46.7% in the 3 months prior. Combine higher rates with inflation and disposable income is down. Households in the lowest 20% of income spent $7,400 more than they earned in third quarter. A year earlier, they spent $6,550 more than they took home. Meanwhile, savings were hit too. The top 20% of households did save, but the $14,200 per quarter is down from almost $17,000 a quarter in 2020. As debt becomes even more expensive, what's the point of real pain for Canadian households? And does the Bank of Canada risk losing control and tipping too many Canadians right into it? Benjamin Tal is Deputy Chief Economist at CIBC. Benjamin, great to see you.
A pleasure. Thank you.
So I think for a lot of households, Benjamin, we know at this level they're kind of hanging on, hoping that the hikes are over and now wondering how long they have to keep the payments at this level. Paint the overall picture of how problematic the household debt is. We know in the pandemic we built up our savings and did a little bit better overall. Are we back into trouble here?
The short answer is yes. The economy and the consumer are extremely sensitive to higher interest rates, more in Canada than the US, because we simply have more debt. And remember, our mortgages are for 5 years, theirs for 30. So the tiny Bank of Canada is more powerful than the mighty Fed. And not only is the Bank of Canada more powerful relative to the Fed, it's more powerful relative to itself. In the past, because in the past we didn't have the same amount of debt. So the increase in interest rates in the past is not as significant as today. Therefore, this consumer is feeling the pain. And this, unfortunately, is just the beginning, especially in the housing market.
So let's drill into that a bit. When do you think we could expect rates to go down? If we've even leveled off here, we could well see another hike. We shouldn't say that we won't. But let's just say we've kind of plateaued here in the best case scenario. Would you expect to stay at this plateau for months and months and months, or could there be a time late in the summer, perhaps, when we start to see rates soften?
Well, until very recently, the market was pricing in a possibility that the Bank of Canada will cut twice in the second half of 2023. Now this dream is over. It's not going to happen after the two very strong job numbers that we got in the last 2 months. So the Bank of Canada is telling us we are not touching interest rates until 2024. So we have a full year of interest rates remaining at elevated level. Why? Because the Bank of Canada wants to make sure that inflation is dead before they start cutting interest rates. You don't want to reignite inflation the way we have seen during the double-dip recession of the 1980s. They don't want to repeat past mistakes. So we doubt that the Bank of Canada or the Fed will touch interest rates in the second half of 2023 in order to cut. In fact, they will wait until 2024. And then the question is, okay, you cut. To what? So remember, we started this madness at about 175 Bank of Canada rate. We are at 4.5. Let's hope that we stay here at this rate and it doesn't go higher. You stay there for a year and then you go down to what? Let's say 3. Why? Because there are basically 4 inflationary forces that are cooking. We have deglobalization that is inflationary. We have just-in-case inventories, replacing just-in-time inventories. We have a labor market that is more expensive and tight. And we have green initiatives that, let's face it, are all inflationary. 4 inflationary forces cooking. The target is the same, 2%. It's not going to change. It's not going to change. I'm telling you now. The Bank of Canada will keep that target at 2% for now. So you have more inflation coming, the same target. Therefore, by definition, interest rates have to be higher than they were before, maybe double that compared to what they were before, 175.
So, okay, so you make a pretty strong case here. We've only got a few seconds. You alluded to this. Does that mean the housing market has yet to bottom? Do you see further pain for that particular asset class?
The short answer is yes. I think the next few months will not be pretty. I think that the prices will continue to go down. And that's a good thing, by the way. We need a slowdown in the housing market. Then the recovery will not be as strong, given that the interest rates will remain elevated for a while. So this housing market, it's not over. We are very close to the end of this saga, but it's not going to recover very quickly.
Benjamin, so good to have you. Appreciate your time.
A pleasure. Thank you.
Benjamin Tell, Deputy Chief Economist at CIBC. Coming up, rates are up, costs are up, and savings are down. Some practical advice on what to do about it. Stay with us.